My name is Anish Dave. I'm one of the owners of the Broward Real Estate Association and the Miami-Dade Real Estate Investors Association. My partner Ryan is actually working with a homeowner right now with our students working on a deal. So maybe he'll pop in a little bit later. But he's actually out there getting deals closed with our students. So we'll see if he'll pop on in a few or not. Um, and I see a lot of you guys have already been following us for some time. We have been around. We are a couple little things. We are a chapter of National RIA. National RIA is the organization that endorses real estate clubs. We're the only approved chapter in Dade and Broward County. So I think that's always important. What that means for you, they do background checks, they do financial checks, criminal checks. And that's how we get some of those benefits out there with National RIA. Some of those benefits include discounts at Home Depot, Office Depot, Arcana, insurance, Rent Perfect. So if you want some more information about our memberships, I'll just put a little quick poll on there. Go ahead and let us know. Someone in our office will reach out to you. And yeah, we'll take it from there. So enough about me. On that stuff. Also on board, if you're also looking at your video screen, is Alexa. That's one of our managers, or I should say the manager of BRIA and Miami-Dade RIA. So if you need anything at our office, she's the push. Ryan and I are so-so, meaning, questions about memberships, appointments, how to use your benefits. So Alexa, if you want to say a quick hello and unmute yourself.
Hello, everyone. I hope you're having a great day today. My name is Alexa, and as Anish said, if you have any questions about memberships, about our mentoring program, anything at all, you can give me a call. You can email me at my email. I just put it in the chat. It's alexa@wjl.net.
Awesome. Perfect. And now, enough about us. The guy that you're here to see, well, first of all, one of my friends, Jason Clark. I've probably known you for, I think we're like about 5 or 6 years, maybe 7,
like that.
somewhere around there. I know you have maybe 7, somewhere around there.
Time flies.
Too long. Yeah, so we're friends first and foremost. Second, Jason's actually did my deal, my investment property that he was able to get done when
super easy.
Yeah, right. Other lenders said no. Probably the longest list of
conditions
needed list of that you've ever seen. It was like pages and pages, but he actually got it done, and it was an investment property at 3.75. So I was very lucky to even get that out there.
That was during our pandemic, right when the pandemic hit, and the lucky thing is no trees were destroyed. We saved all the paper in our virtual files for you. So we printed no paper.
Absolutely. And so today's point, today's webinar with Jason, and I'll let Jason introduce himself of all his experience, but it is to get you back into financing, meaning, A, you might be an investor and you have a ton of equity and you might want to tap into financing. B, you might be a rehabber and you probably want to know how to rehab a house. We have webinars on that, but how do you sell it to an end user? FHA, conventional, to get top money. Or maybe you want to do some of the house hacking that's popular. It's a fourplex and you want to live on one side. So today, we're going to kind of touch on all those topics. And I'm going to kind of let, our audience kind of run it with some of the questions that they have. But Jason, if you want to kind of introduce everyone who you are.
Sure. I'm Jason Clark. I am with Smart Home Loans, been in the mortgage business for about 20 years, maybe 21 now. I run a small team over here in Pembroke Pines, Florida. And, our core business is obviously FHA conventional, but we do have a lot of the non-prime products that we offer investors, bank statement loans, P&L loans, cash out refinances and things of that nature, home equity lines of credit. That's a big one right now, starting to come back. So that's more or less what we do in the mortgage business.
Absolutely. And you've been in the mortgage business, what, is it 20 years or do I have
I think it's 20 something years. Yeah, I'm losing count now, but it's up there. Yeah.
Yeah. So, I mean, Jason's been through everything. So he's been through a crash once.
Yeah.
Now he's been through a pandemic.
Yeah, that's
So,
true.
yeah, there's a couple things that and the thing is like you always have to adapt and pivot. Why don't we kind of just, get kind of into it and talk about my favorite FHA. So Jason, you got to remember, not all of our people are
Yeah,
astute in financing.
right.
So do you want to first explain what FHA is and how it's different? So what kind
All
of is
right.
it?
So what we love about FHA, right? It's the government sponsored loans. Minimum down payment is 3.5% down. Everybody gets the same mortgage and insurance rate, which is 0.85 for everybody. So that's one good thing. They take all types of lower end credit, but and you get a good low rate that gets advertised out there. What I like about it is that you can buy these multifamily properties, duplexes, triplexes, quadplexes with 3.5% down. And just last night, I was kind of going through MLS and I was looking at a bunch of properties from Miami all the way to Palm Beach that are active, and they're getting more expensive. But with that, the FHA loan limits go up higher. So if you're a first time investor and you haven't been able to use FHA financing yet, that'd be a great opportunity to get your foot in the door. You can control a huge asset, let's say a $500,000 triplex, live by it as a primary. You get a very low rate. You have your tenants paying you rent, which is virtually going to pay your mortgage. And it also helps you qualify, so people that are kind of on the bubble for qualifying, that rental income helps kind of push you over the hump there. And I have an individual right now, he couldn't buy a single family home. He's got student loan issues where he can't qualify for the house that he wants. So I said, look, why don't you shift gears a little bit and start looking at some multifamily? And, his realtor didn't bring that up to him and it was kind of new to him. So I educated him about it. And I said, look, if you're able to purchase this with 3.5% down, the same kind of money you're going to buy a single family, but now you can qualify. So that's the one thing with FHA I do like a lot as far as finding those multifamily properties out there. And there seems to be a lot of them for sale right now.
Yeah, and that when you were talking multifamily, just so you guys know, it's up to 4 units.
Correct.
And you do actually have to live in one of the units
Correct.
for FHA. So I think that's really important, and not just on multifamily. And what Jason's talking, 3.5% down. So, let's say for easy numbers, I'm not sure how many houses you find for 100,000, but you're looking at $3,500 down.
Right.
Also, if I'm correct, and just so you guys know, my background is financing. I was a mortgage guy like Jason. I'm still licensed, but I'm not actively doing mortgages. So I'm not up to speed fully. And that's why I have Jason here too. One of the things is also seller contribution.
Yes.
So can we kind of talk about what that really means?
Yeah. Good point.
If you're on income.
Yeah. So for FHA, you have a 6% cap on seller contribution. So the comparison between conventional, let's say you're putting down 3% on a conventional loan, you're capped at 3%. But with FHA, you're putting down 3.5%, you're allowed up to 6% seller contribution. And that contribution can come from the seller. All right. It can come from the lender, it can come from the realtor. And in a lot of cases, the way we structure deals is it's coming from everybody to kind of make the deal work, especially if somebody's short on cash. We'll go ahead and have a realtor chip in. We'll have the lender give a lender credit, and then we'll have the seller go ahead and cough up some money too, so we can get to that 6% contribution. And in a lot of cases, people are buying homes where the initial cash outlay might be 25 grand, but after we get all these credits in place, and by the time you get to a closing table, it might be 17. It might be 18. So you save a nice little bundle of money there, and that's what's special and unique about FHA. So that definitely helps out with people that are a little bit short on cash.
Yeah, and to add before, and you're exactly right. You get a little bit, a little help from everybody. If I would tell you, especially if you have a good realtor, they don't want to go down on their commission. They're going to try to push it from the seller.
Sure.
But at the end of the day, you're trying to get the deal done. So I think it's important to have the right team, right? You want to have a good realtor, a good lender, title company that actually knows that beforehand. What's funny is like I already got a bunch of questions on this, so I'm gonna just kind of go through these questions as we're getting them. Also,
Okay.
is FHA for first-time home buyers or all buyers?
You know what? Good question. It is for all buyers. Okay. I mean, the way they define a first-time home buyer is somebody who hasn't owned a home in the last 3 years. All right. And so they'll take a look at your tax returns. Obviously, in 2019, if you show mortgage interest you owned a home somewhere. They also run their reports, these lenders, and they'll find a property that might be free and clear, and they'll say, hey, your borrower did not disclose this home they have over in Daytona, which is free and clear. What's the deal with it? Since it's 100 miles away, Daytona, for example, you can still use FHA financing because they do have a 100-mile rule. So a lot of people are not aware of that because they can buy an FHA property on, in Hollandale, and then they'll go buy one using FHA in Plantation. You can't do that. So you got to use the 100-mile rule. So for example, Hollandale to maybe Orlando, you can buy one in Orlando and use FHA financing again. It's not necessarily there to kind of churn and be used as investments, but it is a good vehicle. But you don't necessarily have to be a first-time home buyer. Okay, you could have owned a home in the past and still use it. But even if you do own a home and it's 100 miles away, or a second home in Connecticut or South Carolina or something like that, then we just got to write a letter of explanation and kind of like define what that property is.
I'm just going to add to that, is because it's really important what you said, is so if you do have another property in the US, disclose it, right? So, and they definitely tell your mortgage person first and foremost. Tell them the real deal of what's happening.
Yeah, I kind of like to say, like, I'm your priest. Just tell me everything, because if you don't tell me it, it's going to be found out anyways. And then don't be embarrassed about it or anything like that. Just let me know what's going on. So this way I can go into battle for you and structure it correctly, because these underwriters, they're kind of, you're guilty until proven innocent type of method, and so I don't want red flags to be popping up that I should have identified ahead of time. So just tell me it all, and lay it all out there, and we kind of work it out and structure it the right way, and we, we'll come up with the right story for you.
And think of it this way: is like, as a lender, right? If you were going to lend out money, and I'm lending money to Jason, and I don't tell him everything in the beginning, I'm thinking, is Jason going to really pay me back? Right. So I'm not defending the lenders. Again, you just want to make sure you tell all the information up front. It's going to be a better chance of your loan getting approved, is number one, and on time. Right. So I think that's important. Jenny Lean's asking, can you keep an FHA loan if you move out of your house hack after 1 year? So I think like they want to live in it. They do an FHA loan. They live there 1 year, and then they want to move out.
Sure. You can keep it. You got an FHA loan. As long as someone's paying the mortgage, I mean, look, that happens all the time. People get relocated. People move because of marriages, divorces, all kinds of stuff. So there's no rule that says that you have to stay there forever as a primary. You're buying it as a primary. You're signing documents that you're buying as a primary, but you might have gotten a new job offer in another city, and there's nothing wrong with moving out of there and leaving it up as a rental, as long as the mortgage is getting paid, because you're not going to have somebody knocking on your door looking to see if Bill Smith lives there. They're just knocking unless the mortgage is not getting paid. So that's the issue there. So yes, you can.
Yeah, and so Miguel's asking, if in the past he bought a personal property with FHA and refinanced to a conventional loan, would I qualify for another FHA loan?
No.
So FHA,
the 100-mile rule kicks in again, right? So FHA looks at all loans, all properties. And I mean, look, the program is set up for people looking to buy a first-time home buyers. That's generally what it's set up for. It's not necessarily has to be that way. But yes, if you refinance into a conventional and you use FHA financing within 100 miles, FHA is going to have a problem with that. It's just any property, any loan. And we kind of learned that the hard way. So we found that out.
And I know, like, so just I know I'm getting some of these questions. Yes, it has to be owner occupied, so you actually have to live in it. Is number one. I know Ron's asking, is there a minimum time frame the owner lives in it?
Yeah, that's a loaded question. A minimum time frame. Yeah, you want to live there like normal. I mean, there is no minimum time frame. I don't see that in the rule book. I don't think it's a technicality or anything like that. Things happen in life. But the point is not to necessarily use the product that way. But yeah, you want to live there. I mean, if it's 6 months, a year, that's fine. But things happen.
Yeah, and the thing is, then, like, Jack, I know you're asking how to get around the live-in. So what we're not going to teach you today is mortgage fraud, right? So I'm just going to kind of throw that in there. I
Yeah,
know we
right,
live in South Florida. The story has to make sense. Live in it.
right,
You are signing documents saying that you're going to live in it.
correct.
So, God, I like what Jason's saying. They're not probably going to knock on your door. You know, if everything's paid, it's usually fine. My point is, don't knowingly. I don't know. I don't want
Yeah,
to say
we
lie
we
to the
don't want
banks.
to abuse the product. That's the main thing. It's
Yeah,
like
use the.
we're not
Yeah,
here
you don't
to
want to
abuse
abuse
the
it.
product. We're here to
Yeah,
use the product and its availability, not to start churning through an FHA in Tampa, Miami, Jacksonville, and before you know it,
yeah,
they're catching on to you. So that's not
yeah,
going to
yeah.
work.
So absolutely. And then since we are still talking about FHA a little bit, so versus conventional.
Hmm.
You want to kind of go over what a conventional loan is, and so FHA is guaranteed by the government,
Right.
the Federal Housing Administration. That's what FHA stands for. Do you want to
Correct.
kind of talk about what a conventional loan is, and then we'll kind of talk about the
Sure.
differences?
Look, the conventional loan side is you got your Fannie and you got your Fannie Mae. All right, you have your Freddie Mac. Those are the two big government entities that buy up all these loans and replenish the lenders' coffers. The reality is, yes, there is a 3% down product with both Fannie and Freddie for conventional. It's a lot tougher to qualify for those now. They really fine-tune the system. So if you don't have a really strong credit score and good assets, it's hard to get approved for 3% down. But that's the minimum. But most people go with the 10% down. It does carry cheaper mortgage insurance if you have a stronger credit score. Okay, so I really try hard to make sure my customers get their scores up through a rescoring method or something like that, because the mortgage insurance when you have a 680 credit score is through the roof, and it's almost impossible to get you qualified. You might want to go with FHA, but the other thing with conventional is that it does allow for condo purchases. Okay, so a lot of condos down here in South Florida definitely want to go conventional with it. We've tried to go FHA in some condos. They have a program out there for it now, but it's horrible. Honestly, like they have a program for FHA for condos, and it's very tough to get them approved. And it's much easier to go the FHA, the conventional route. Conventional financing, if you're going to buy an investment property, single family home requires 20% down. If it's a multifamily, like a duplex, triplex, or a quadplex, you need 25% down. So those are some of the biggest differences between FHA and conventional loans.
Wow. So in the chat, if you want to go ahead and say if you're following us, I know Jason just gave a ton of information, so do not freak out. We're just kind of going over like a basis of the things out there in different programs. So one of the things is, and I'm going to kind of talk about basic stuff too, is so when Jason gets your application, it doesn't directly go to a bank per se. Like, do you want to talk about some
Sure.
like how the process with DU and all that LP? So it
Right.
you get all the information. Let's talk about, hey, listen, I'm thinking about buying a house, my wife and I. What's my first step? My realtor said I should get some financing.
Yeah, you want
And
to
they
get
gave me your
pre-approved.
number.
Right. So what I do is, I take the application, right? We put, I want to take a perfect application. I'm really picky about that. And I've learned over the years that if you're missing stuff or you're kind of, I'm half-assing it on an application, that's not going to help us, get a perfect application in, pull credit, identify what the derogatory credit is, if there is any. And then from there, I basically structure the deal and I figure out, okay, well, you're a better candidate for FHA or for conventional. And sometimes they're kind of running neck and neck, and I would prefer you go with the conventional loan, because the conventional loan, the mortgage insurance falls off at 80%. FHA, mortgage insurance stays there for the life of the loan. So that's another big difference there. But once we go ahead and figure out how to structure your deal with your cash to close, then we go ahead and send out our pre-approval letter. It's basically an email with the letter and the DU findings. The DU findings are desktop underwriting findings. Okay, so every lender, every mortgage broker, loan officer in the country runs your file through Fannie Mae system to see if it spits out an approval. All right, if we get an approval, that means we got some solid ground to stand on. Okay, doesn't mean you're conditionally approved, just means that you're workable. All right, so we get you out there, you're shopping with your realtor, you get your contract put in, then the contract comes into us. We then go ahead and take your documents, upload them into the lender system, disclose the loan to you, you e-sign it, and then from there it's going to go to processing. Our processors process the loan, and then it goes to the underwriter. At that point, the underwriter is going to make a determination on a conditional approval. Okay, so at that point, they might ask for a pay stub, an extra W-2, maybe an explanation letter on an address or something like that. And then they will issue us a conditional approval, which is great because now it's a good milestone mark for everybody. We let the realtor know, we let the listing agent know, we obviously let the buyers know. And then from there, we start working on getting our conditions for the underwriter to clear up so we can get a final approval. Okay, so that's kind of a short, condensed version of what we do. In between all that stuff, you know, there's a lot of moving pieces, a lot of things going on simultaneously while we're disclosing the loan. The appraisal's getting ordered, you got the inspection you're working on. So it's a lot of management on our side as far as the realtors involved, the processing, the borrowers and stuff like that. But that's what you want when you go out shopping, especially down here in South Florida. Most realtors know that if you're coming through the door and you don't have DU findings or a pre-approval letter, they're probably not going to look at your contract. If you have a cash offer, sure, that's going to stand out, but you're probably going to have to submit some bank statements along with that to verify that you have the cash. All right. And lately, we're starting to see a lot of intense bidding wars going up. I don't know if you're seeing that on your side, Anish, but it's
Absolutely.
pretty wild.
It's pretty crazy with that, you know, the pandemic happening. I know a lot of people are relocating.
Yeah.
Me growing up in Jersey, I see a lot of New York, New Jersey, Northeast people coming
Yeah.
down, working from home. So now you're competing if you're on the retail side. The investor side, you know, for us, it's been pretty good because we're selling to them.
Right.
So, you know, we're going direct to them off market. So we've been kind of, you know, I don't want to say looking out. Our business plan is very different versus other, you know, people out there or other investors. The other thing I think that's really important to touch on, as you heard Jason, what would you say? It's kind of funny. Like, I don't know, what number of people do you think touch a loan?
Oof,
From like,
that's
I
funny.
was thinking like, I would probably say about 20.
Yeah, it's like a whole
Or
football
so.
team, you know, like everyone
Yeah.
touches it,
And
hike, they throw it around. There's a lot of people involved, you know, I would say at least 10, you know, I mean, you know,
yeah,
between myself, the processor, underwriting, and you have a manager with the with the lender, then you got the closing team and things like that, title people. So there's a lot
yeah,
of people involved in the loan and there's
yeah, an
little things.
inspector, realtor, you
Yeah.
know, a second part of it. So, and the reason why I'm bringing that up a little bit is because, you know, when you're trying to close in 30 or 45 days, right, depending on what you're trying to do,
Mhm.
it's easy, right, for things to go wrong. Meaning, if
Yeah.
someone's sick, someone's out. On your side as a borrower, right? One of the biggest delays is what? Not getting you the information, right? What drives
Yeah.
you nuts? You got to say
I
something
mean, you know,
on
it's
the
like,
borrower side.
right. In our world, it's like if I ask for pay stubs or something like that, you know, and I get it that day, that's really like 2 days in the lending world. You know, like if you take 2 days to get to me, it's 4 days. So it does take a while to get it uploaded because you got to remember these underwriters are underwriting. I mean, one of our underwriters had like 300 files. You know, she's up in Michigan, and she's like, look, I'm gonna get to your file, but I got like 14 ahead of you. Okay, no problem. And you know, we give them that time, and we don't try to pressure them, but you know, obviously, you know, things happen, but the industry itself is pretty busy, you know, and it's you know, right now we're bringing in processors to train, you know, and loan officer assistants to train, like a lot of these younger kids out there in their 20s and stuff like that, because we need the help, and everyone is working remotely, which is nice, but you know, a lot of it is belly to belly. You know, you got to get in there and train, but yes, as far as you know, people touching a loan, there's a lot of people that go ahead and put their hands on it and mess around with it. So put it that way.
Yeah, absolutely. So I mean, I mean, it gets a little bit challenging, you know, when you have a lot of people, you know, in the kitchen. It's probably the
Sure,
easiest way to
that's
say
true.
that. I do have, I mean, I don't know if you're noticing, but I have a ton of questions. So I'm just going to kind of
Yeah.
go through some of these also at the same time. Kenton's asking, what's the rough amount of mortgage insurance for 3% down? Do you want to actually explain mortgage insurance? Because I know some people think it's insurance on their house,
Yeah.
when it's not. So I guess we
Well,
could
I
touch that
mean, a
first.
lot of people have this preconceived notion that mortgage insurance is horrible, you know, and I talk to borrowers all the time, like, oh, I want to put 20% down because mortgage insurance, you know, is the big bad wolf. And I'm like, well, quite frankly, it's not, you know. Let's say, for example, if you don't put down 20%, right, and you put down 15%, you got a really good credit score because everything's based off of credit, loan amount, and loan to value, right? And so I had a gentleman, I think his mortgage insurance was $64, but it ended up saving him 17 grand, you know? So why would you want to lay out 17 grand when you could probably renovate your kitchen or put some new floors in? You pay $64 a month. It comes off in a little while. It's not there forever, but that's sometimes how it works. But mortgage insurance is basically there to protect the lender in case of a default, right? So back in the day, in '07, '08, that's why all these lenders went out of business, because everyone was defaulting and all the mortgage insurance companies were going belly up. They just couldn't pay it out that quick. So it does protect the lenders from making those high loan to value financings, 3% down, 5% down. The more money you put in, up to 20%, the lower the mortgage insurance is. But if you got really good credit, the mortgage insurance is pretty aggressive and it's pretty cheap. So it's not the worst thing in the whole world. And quite frankly, I think more people should utilize it, as opposed to just saving a
Yeah.
little more money to maybe fix up the homes and do some other
Yeah,
things.
because there's always, if you're going to put money, you want to buy furniture, you want to redo the
Yeah.
kitchen. That could be, depends on, the type of home. I mean, if it's new construction, it might be a little bit different. You
Right.
might want to put some money in your retirement. So, or it's just some oops money, like God forbid something happens, the AC goes out. You want to have a little bit of a cushion. I know most financial planners that I talk to, they always say you want at least 6 months of, expenses for
Sure.
emergency. So to an extent, rates are low. It's not the end of the world.
Right.
You just want to make sure, don't always think it's a bad thing. It's probably what we're trying to tell
It's
people.
not.
Uh,
And to answer the gentleman's question, it's a factor. It could be 0.15, of the loan amount, or it could be 1.15. So for somebody with worse credit, I've seen it as high as like $568 on a transaction. I was like, this is going to kill the deal, And so we have to rework a few things, but it's not the worst thing in the world.
and so Roy's asking, how soon can you qualify for a mortgage after a bankruptcy?
Oh, okay. So that for FHA, okay, Chapter 7 is 2 years. Chapter 13 is going to be 4 years after the discharge date. For conventional loans, it's 7 years. I believe it's 7 years for Chapter 7, and I think it's the same for Chapter 13. I would have to double check. I haven't had that question asked in a while, but I know that it's out there. FHA is usually the go-to when it comes down to bankruptcies and things of that nature, and short sales and stuff like that. That's 7 years for conventional. Um, so I have to get my chart for that. That was a good question.
Yeah. Yeah. So minimum 4 is what, if you could go FHA and you're going to live in it,
Mhm.
remember 4. That's what,
Okay.
if you're 7, Chapter 7 bankruptcy. Steve's asking, what things should the self-employed have and to do to be able to qualify for FHA loans? So you're a self-employed borrower.
Yes, self-employed.
So
I love them. Okay, so self-employed borrower, this probably pretty much goes for FHA or conventional loans. You're gonna have if you have an 1120S like a corporation, we're gonna need your business returns, all right, for the last 2 years. We need your personal returns for the last 2 years. And then we're gonna need a P&L statement for whatever months. Let's say January to February. If it's, February, January to March, we'll need a P&L statement. So those are the two main documents that we're going to need, is those business tax returns and the personal tax returns. And then we take that and we just put an average together and we come up with an average income. All right. But the reality is, you might have a great year in 2020, you made 100 grand, but the year previous you only made 50. So an underwriter is not going to just give you that average. They're going to mark you up from your lower end year. So for 50 grand in 2019, they'll mark it up 20% or so, and they'll use that figure. They won't give you the whole dollar for dollar. So keep that in mind when you're filing, because some people think, oh well, I made 250 grand this year, but the previous year I only made 100. It is not going to help you get a mortgage. We still would need another year of you making 250 grand to actually use that income to qualify.
that was a mouthful there.
I know,
and,
right?
and again, I know some of the
Self-employed.
questions, well, again, today we're giving a lot of basics.
Sure.
So, again, he's got to see the whole picture, assets, but, that is really important is, if you have a good accountant like me, I deduct
Yes.
a lot of stuff, and you see my tax returns.
Mhm.
I'm deducting a ton of stuff. it's good, for me, for the IRS, it's not good on a mortgage if I'm trying to go conventional or FHA because
Correct.
it doesn't show enough income to an
Right.
extent,
To an
right? So you
extent.
got to
Right.
pick. You can't do both, right? Is what I always tell
Yeah.
people. You're going to pay one way or another. Either you're going to pay a little bit higher rate on a mortgage, or you're going to pay more in taxes. Is really what I tell people.
Yeah. You're right.
Jenny Jenny Lynn's asking, what qualifies for really good credit? What do you
Really good
consider really
credit.
good credit
I
for
I
the bank? I
mean,
should say.
I like 740 and above. I think that's where the barometer is for really good credit. There is people out there with 780s and the 800s, but if you get to 740 and above, that's kind of premium credit right there. 680 for conventional is not that great anymore. It really isn't. It's great for FHA. 680 for FHA is wonderful, but 740 and above is I would consider really good credit. And then when you get to the 780s, that's excellent. Most people are not really there. So, but everyone's a little different.
Yeah, and just so do you want to talk about the three credit scores? So it's not just,
Sure.
like if I use, I don't know, I forgot some of the online things like through my credit card.
Credit
Hey,
Karma,
they said
something
I
like
got
that.
800.
Yeah.
Yeah, I get Karma, and I'm not picking on those guys. So like, let's just say my Karma score is 805, but my credit
Yeah,
score
I
when
seem
you
to
pull it,
battle people on that all day. Like I had a gentleman the other day. He's like, "Well, my Credit Karma shows 805, and I pulled his credit. He does have an 805 with Equifax, but Experian shows a 769, and then a TransUnion shows a 721. So his scores is 769. Still good credit, but he was all depressed and bent out of shape. And I said, hey, look, the Credit Karmas are a marketing tool, right? And so it keeps your eyeballs looking at the app. If your credit score is going down, you're probably not going to look at that app anymore. It'll probably get discouraged. So it keeps
right?
pumping it up. Now, when you got really good credit, it's pretty accurate. It's people that are in that middle of the road, 650, 640, 680s, where Credit Karma is a little bit kind of, not consistent, and so when we pull credit, all of a sudden it drops 60 points. And we're like, hey, you really have this credit score. I don't care what Credit Karma says,
Yeah.
because I think Credit Karma is used to market to a lot of people, but it's not bad. It's gotten better over the years.
Yeah, yeah. It's just that I know the same thing that happens for I'm like, oh, my score went this, and
Yeah.
they're upset about it. So what Jason's saying is that they pull from all three credit bureaus. They're going to take the middle one.
Yeah, that's
So
true.
that's what you want to make sure. Some of the cool things that Jason's company and some of the other companies might do is they have a credit rescore.
Yeah.
So let's say you're work in progress. I'm going to use that, right? And your
Yep.
score is not where it needs to be. They could help you out during that pre-approval process
Mhm.
of, hey, maybe if you pay this off, or if you do these things, your score may jump up. So
Yeah.
don't think of it as a death sentence that, hey, I didn't get approved. You'll be able to, whether it's a bankruptcy, whether it's, I don't know, short sales or any of that kind of stuff.
Yeah.
So
Like I said, I had a gentleman say, well, I have an 805 with Credit Karma. And when I pulled his credit, I noticed that there was a medical collection for TransUnion and Experian, which is the one that would dragging his scores down. So I said, hey, look, if you settle with these people, and he doesn't want to settle, he's all complaining, I don't want to settle with them. I don't need to settle with them. I said, look, the reality is it's going to haunt you and go with you wherever you are. It's credit. It sticks to you. I'm sorry. It's just the way it works. You either settle with them or or you don't, but it's always going to be there dragging your score down. So he ended up settling, and we were able to get him like 80 points, on those medical collections. Those are pretty good. We can get those deleted, get me a deletion letter from the source. I put it with my credit team, and then they update the three bureaus with the same credit report. We don't pull a new one, and then it go ahead and spits out a rescore. And so he was really happy when it was all said and done, because I think he settled for a few $100s. And that was one collection. But I've had people where it's like a mountain full of collections, and if you're scrubbing the bottom of the barrel, 540 credit score, and you come to me, I'm going to help you get your credit squared away. I'll tell you exactly what to do, and it takes me a good hour, maybe an hour and a half, to identify all that stuff and tell you what to do. And then it's on you. I'm not credit repair. I'm just like your credit blueprint, because I'll tell you what to do, but that means you got to do it. And some people take the initiative, and some people don't. And then some people that don't, they come back 6 months later and like, hey, can you pull my credit again? And I'm like,
yeah,
you're still in the same spot. You didn't do anything I said to do. So those things happen.
yeah. And Donise has got two questions, so I'm going to kind of work with both of them here. She
Okay.
says she's in Miami and she wants to do a second home in Georgia would that work for FHA if I'm not going to live there full time, but I have the intention to live there periodically?
No, don't do it. I mean,
There you have it.
the reality is you could probably contact a broker up there in Georgia. They might be able to pull something off for you like that, but you're probably better off putting down the 20%, buying as an investment property or something like that. Um, it would be a
Yeah.
little tough to qualify. I mean, I don't know your situation, but if you're moving up there as a second home, you got to be able to afford your current home and your second home. And if you're planning to rent it out or something like that, that might not be the best thing to do.
And her second part, maybe this is why she was asking, for first-time home buyers with FHA, do they need to be the only owner? For example, if I want to purchase jointly with my son, and I'm going to assume your son's going to live in it, and maybe she could be a co-signer.
Sure. Yeah, you could do that. We could do that with FHA and conventional loans. It's a non-occupying co-borrower. If you're purchasing a property and you're co-signing for somebody, but you own another property, you're not going to occupy that property. That is a possibility where your son can live there, and you're relieved of the debt as long as he's making the payments from his checking account every month to the mortgage company. Okay, so that's one way to relieve you of that debt. But give me a call. We'll figure that one out together.
Yeah, absolutely. And we'll put Jason's information in the chat to contact him, or so don't worry, if you email us, he's one of our corporate vendors. So I know you guys have super specific questions. So if they're really specific, I'm gonna leave that for Jason if you down the road to actually contact them. Marcel's asking, do you lend to international investors, and what are the requirements or guidelines?
That's the last international investor I lent to was right before COVID, and it was a bank out in California called Athos Capital that we used, and it was a really good deal. It was a lady from Mexico, foreign national, and we just closed it right before the COVID came. And from that point on, it's kind of been very bleak. Honestly, I haven't had too much call for it. I'm sure they're out there. I'm sure I can find you a foreign national type of loan. I just have not been seeing much action as far as that's concerned. But these lenders are starting to come out the woodworks now, and then right now it's kind of like full throttle. We still have COVID overlays on a lot of loans, as far as requirements, pay stubs, cash in the bank. But for the foreign national investor, yes, I'm sure we can get you some financing for it. I just don't know off the top of my head what the loan amount limits are, or LTVs. I would have to say at least 30% down, maybe even to 40% down to get your foot in the door.
And so Ed's asking, if you have a loan, but the deal falls through, generally, how long will the loan be available if you find another similar property? So I guess, let's say they go under contract, the inspection shows something, they can't negotiate it. How long is their
approval?
I guess their credit and
when I pull credit, it's good for 120 days. Okay. Most lenders' approvals are good for 90 days, 90 to 120 days as well. So yes, if you do find a property and you put it under contract and you get the loan, you get it approved, and all of a sudden something falls apart. I mean, obviously we have to resubmit that loan again. We have to go through the whole process again, redisclosures, it's a new property address. So we usually try to send it to the same underwriter that underwrote you the first time around. So it's a little bit more of a streamlined process.
Perfect. So now, okay, I'm going to kind of move, although I'm answering some of the questions while they're popping up there too. Let's kind of talk about something else, because otherwise we're going to be in the FHA conventional conundrum forever.
Yeah, right.
On that portion, right? So some of you guys are investors. So let's talk about, I'm a professional investor, and, I've been reading a ton of books. I'm on Bigger Pockets, and everyone says I should own an LLC to buy properties.
Nice.
So what's the difference on the lending side between, if I own a property in my LLC, or I want a property, meaning how much money down, versus, in my own name in a conventional. So let's kind of go over the differences. So let's say I'm looking at investment property, and it's going to be in Anishinaabe. How much money down, and I have full doc. We could use that, I guess. Full documentation that I qualify, and I have excellent credit. So
you want to purchase it in an LLC, and we have programs for that specifically for investors. you're looking at 20% down in most cases. If it's going to be full doc, obviously we'd have to break out the tax returns for that business. We'd have to see the operating agreement to see if there's any other members on that operating agreement. And so if there's other members on there and it's not just you by yourself, then a lot of times the lenders want that member to be on the loan. Okay. You might not want the lender on the loan. Then maybe that's the deal you got. He's got the money, you got the credit. So what you have to do is then rework that operating agreement and get him off of there and get him off of Sunbiz in some cases. And so that's a little tricky, but it could be we do those. We help you kind of guide through all that stuff. But for purchasing in a corporation name, yeah, you're looking at 20% down. A lot of people purchase it in their person's name, and then they go ahead and quick claim it on over to an LLC or a corporation. That's fine too. That's, a lot of people do that. There's nothing wrong with that.
So if I put in my full name, can I get away with 5% down or 10% down, or let's say it's a single family? Right? So I'm looking as a purchase.
Yeah, I mean, if you put it, you're saying putting in your regular name, your person's name, right? Like just your name. Yeah. 5% down, you can do that all day. But if it's an investment property, you're looking at 20%, 25%. You're not going to do that under your name. But as far as the corporations are concerned, yeah, that's kind of how it gets treated, and we see that a lot. A lot more people are buying in corporation names and stuff like that. Obviously, the rate's going to be a little bit higher, maybe the term's a little bit shorter, but you're an investor, and you're looking to purchase it and possibly turn a profit on it in 5 to 7 years or something like that. But there is some good aggressive 30-year fixed programs out there.
And then the second end of that question is, right, I pay cash for the house, or I did a hard money loan, right? I'm an investor, fixed it up. I'm going to keep it as a rental, but I want to get my hard money guy out. So I'm paying 10 to 12%. And I know that you probably have a lot of investors, doing that. Right. What kind, and can I cash out? I mean, we could do a fake example. Let's say we buy a house for 100, I don't know, 130, we put 30,000 into it. I probably should pick even numbers, 150. We're in it all together. My loan with the hard money guy, because I'm good, he's going to help me with the acquisition, and he's going to pay for all my rehab. So maybe I'm in it with him for, I don't know, well, let's say 140, 130. Let's say I'm all in at 130 with him. And now it's worth because I know what I'm doing. Let's say it's worth 250. Right. So we're in it for 250. I mean, it's worth ARV is 250 after repair value, and I owe 130 to the hard money guy. So I just want to refinance them out, right? So can I let's say I finish the rehab in 2 months. I know it's not probably realistic. So I know there's a couple of loaded questions in there. So I'm going to let you kind of walk me through.
Yeah, with those types of loans and purchases, a lot of the lenders are going to go off of the purchase price, right? And so whatever the purchase price is, especially if it's not within 6 months, because you probably want to use the appraised value, and that's going to be used after 6 months. There's a seasoning requirement, okay? And usually it's 6 months. There might be some lenders out there, because a lot of different portfolio companies are coming out and they're basically rolling out the red carpet because they want to get that business in. There might be somebody we can find for 2 months or 4 months, but right now the standard is 6 months seasoning. So your best bet would be to purchase it cash, do a rate and term refinance as soon as you can, so you can get the hard money guy out of there, and you can get yourself a nice, easy, low rate. And then now you have a good relationship with your hard money guy, and he can loan you some more money to purchase something else. If you're using the appraised value, you got to wait 6 months, go through the 6 month process, then you can cash out at the appraised value, pay off your investor, and then whatever the difference is, you can pocket.
Yeah, hopefully did everyone kind of get that? Give me a thumbs up or yes a little bit. So basically what we're saying is you buy the property, you use the hard money or your own cash.
Yeah.
You fix it up. And if you want to take out that money back and pay off the hard money or cash out, just think of the standard industry at 6 months. It's probably the easiest way to tell you. Right. What Jason's saying is there are some banks out there or lenders that if you get it less than 6 months, you could pretty much, if there's enough equity, just pay off the hard money.
Sure.
And that's called rate and term, no cash out. So I know that's a lot of, I know Jason and I, we get a little bit nerdy and we'll start talking about all the stuff. So I know there's a lot of newbies. So the idea, again, we're just kind of giving you a general overview. So I want to, when you have a good mortgage guy, they're going to help you structure this. Your idea is not to structure everything, it's just to give you a good idea. Ernesto's asking, let's see, can't you pay a lump sum to the PMI to eliminate those timeline payments?
Yeah, you could. And I've never seen anyone do it because it's too expensive, and most people just kind of paid over a monthly, the monthly amortization table, so I mean, but you can pay upfront the PMI, but it's costly and not necessarily the most smartest.
Yeah, there's no, I've never seen anyone actually pay it, so I have no idea. And some of you guys that got on a little bit late, so FHA doesn't get rid of the mortgage insurance. Right. You'll have that forever and ever until you refinance it out. The conventional loans, as soon as you get to 80% on that loan amount versus appraised value, it's going to wipe out the mortgage insurance. So I want to make sure about that. And what's funny, we didn't even talk about this. Can you give any VA loan information for multifamily, like the maximum loan amount or more than 4 units? So let's talk about VA loans.
Yeah, VA is unique. They don't necessarily have like a cap on loan amount. It goes basically off of your eligibility requirement. So if like you're in California, the homes out there are super expensive, and what might cost 500 over here cost 800 over there, you can still do 100% VA loan because they don't necessarily have a cap on the loan amount. Now, if it gets into the $1 million range, yes, they're going to start to say, hey, your eligibility only goes up to this much. Now you got to kick in and bring in some of your own equity to kind of offset the down payment. But as far as the multifamilies are concerned, I'd have to check in with you because I haven't had a VA purchase a multifamily unit in a long time. It's usually just a single family home. But I want to say that kind of falls under the FHA guidelines, where the loan amounts increase as there's more units that you're purchasing. So I'd have to find out for you on that. Good question.
Good question. Yeah, I'm like reading through all these things. So kind of just to touch back on it, so you guys know, again, when you go to a mortgage company, you go to Jason, they're going to pull all 3 credit bureaus. They're going to pick the middle one. So I know I'm getting a couple of questions on that. So just want to make sure. What Kenton's asking, what's the current LTV on cashed out refis in general? So let's say you have enough, is it 70%, 75?
80% for a primary, okay. For primary cash out, 75% for investment. Obviously, they're going to want to see reserves, when you're cashing out, as far as like assets and stuff like that. We can go up to 90%, using a little bit of a different method where we would close on the first mortgage as a rate and term, get you that really low rate. And then what we'll do is we'll wait, and then some people like to go with a second mortgage, and we'll put a HELOC, like a home equity line of credit, on the property the following week with a second mortgage lender. And then we'll go ahead and open that up so they have a HELOC line of credit. So that's a little bit of, it's a little tricky to do something like that because we want to get you the lowest rate and term rate. But then after that's closed, then we want to open it up a little bit and get you that HELOC. If we did it at the same time, the rate on the first would be considered a cash out, and it's a little more expensive. So we kind of do like a delay there. But we can go up to 90% loan to value using a home equity line of credit, cash out.
Yeah, that's pretty awesome.
Yeah, they're coming back with the home equity lines of credit now.
Yeah, that's pretty, like, I remember back in the day that was running rampant.
Yeah. Last year they went away. They all stopped in COVID. Like, that's it.
Yeah, and so here's the funny part. It was like, we haven't even really talked about that. But when the pandemic started, I remember talking to, and like, I don't want to say everything was shut down, but everyone was scared on the lending side. They didn't know what to expect. I guess, Ayel, you're probably asking about the quick claim earlier. He's asking, no risk for the bank to trigger the due on sale clause. So if you're talking about quick, I'm just going to assume on this, so you're quick claiming over. So yes, a due on trigger sale clause is anytime you switch ownership, the bank could actually ask for all their money back. That's the easiest way I'm going to say it.
That's the rule.
Have I seen it? I haven't seen it. So that's going to be something, and we're not here to give you legal advice.
Right.
What I would tell you is to speak to your attorney on that portion to see on it. It happens all the time. The other thing is you do have to pay stamps, deed stamps to the county. So that's an extra expense on there. So you just want to make sure. And I mean, Carlita's asking me, how does that affect the taxes? I'm not sure if you're talking about property taxes or,
Yeah, probably property taxes, like if you're going from a primary and have a homestead and now you want to switch it on over to make it an investment property, put it into an LLC, yes, you're going to have to strip that homestead away from there and the taxes are going to go up. So be prepared for that. And I know that like BCPA has a little tax estimator you can check out to kind of get an idea of what it looks like, but it will go up the following year.
so Jack's asking, what's involved with refinancing an investment property that's in a land trust? Have you been able to do any
Um,
refis if you own one?
Land
Sorry.
trust it gets treated the same way as a person because I think, and maybe you can correct me, but I think the land trust is the person, right? Like if there's
Well, but
someone
usually, no, usually they have it as like the 123 Main Street.
right,
So a lot of times, you could change the beneficial interest.
right,
I'm not sure, like you got to pick a specific lender because I know conventional and those guys will never do it.
right,
Um, it's one of these other lenders that might be open to it. I just don't know for long term, like on rate wise, because we have hard money guys. I'll lend on that all day.
okay,
But if we're trying to get a better rate on it, I'll check with Jason on that. It's
yeah,
a
I'll have to
super
check into that
specialized
too.
lender. It might be, some of the lenders that might be with their longer term might be like Lima One Capital. That's one of our corporates.
Mhm.
Lending Home might be able to do it too. But they're super specific. Think of it this way: the bank doesn't like that they don't know who they're lending to an extent when you do that land trust. So for those people that don't know what I'm talking about, that's okay. That's just a little bit higher end on the investment side. So don't get caught up on that portion. Um, you know what's funny? I'm gonna kind of let some of these questions go for a little bit because, and I do see them. So please bear with us. We're trying to get to as many, but I wanted to kind of hit on some other topics.
Sure.
What about, right? And this is my favorite. I go to Quicken Loans
Mhm.
online, right? What's the difference between someone like Quicken Loans and you? Like, meaning they didn't approve me, right? They just said, upload my pay stubs and this, and I'm not approved, and
Right.
I didn't qualify by, conventional or FHA. Is there,
Um,
and I don't get any.
Look, honestly, I mean, there is a lot of borrowers out there that are cookie cutter. They're pay stub W-2. They got great credit, money in the bank, and it's pretty simple. You could probably go to anyone in Quicken Loans. It's not rocket science. They try to make us look silly out there, but the reality is, for those types of borrowers, sure, yeah, you could probably deal with anyone. However, most people are unique and need more of a customized approach. And that's kind of where we step in and we look at certain things, especially in this market where taxes are super high, insurance is high. So we got to figure out a way to squeeze out as much income as we can. Maybe we got to get more overtime or more bonus income and things like that and kind of fight with underwriting for you. So for us, it's more of a challenge, and I accept the challenge. I like that kind of stuff. It's fun for me. Because one thing in real estate that I do love, and I'm sure you do too, Anish, is that there's a start and then there's a finish. And that's unique in a lot of businesses. And that's something that I do appreciate because at the end of the road, everyone's happy when you close on a sale or a refinance or something like that. But the reality is, yeah, I think we put a lot of extra elbow grease into these files to make them work. And to really try to roll out that red carpet and kind of give you a better customer service experience. Obviously, you can get a hold of me on the weekends and at night and things like that. At 8 o'clock in the morning, I'm texting with one of my borrowers on the way to work, and he's talking about, oh gosh, we got to go to Second Mortgage Company and all this other stuff for a piggyback mortgage. But that's the advantage, the accessibility. You just don't fall by the wayside. We try to get back to you as soon as we can and keep up with the customer service aspect of it. But as far as rates are concerned, yeah, we have more flexibility to get a better rate and more flexibility to work with your budget, so to speak.
Yeah.
But honestly, we deal with Quicken too on the wholesale side.
Yeah.
Like that's one of my lenders I deal with, and they give us some special perks for being on the mortgage broker side of the world.
Yeah. So there's a couple little things on there too. So first of all, Jason doesn't mind cookie cutting loans. He doesn't want them all too hard. So I'm going to start with that. So since Jason works on the mortgage, he has his own mortgage company, they get wholesale rates. So he does have lenders that, these big time lenders, I don't know, they're one of your wholesale, guys, but actually, how many lenders do you have, give or take that? that you have access
We have, over the years, we probably have like 30 of them, and that's
to?
conventional, that's non-prime, second mortgage people, hard money people. So like about a good 30, but you know, 5 are our go-to. We know where to bring your loan if it falls out of the conventional bucket. We've already experienced, look, there's a lot of bad lenders out there, a lot of lenders that don't get back to us, and the way it is, and you don't want to deal with them. So we've kind of weeded through the good and bad ones, and we like to work with our top 5.
Yeah. And so the other bonus they have working with you is also, Jason's actually a licensed agent here in South Florida. So he could actually pull up the properties. I know you've done that for people we sent, and hey, let me take a quick look at the taxes. Let me do this versus, if you're online, with any of these companies and they're not going to do all that stuff. So the service is important. The second thing is just because, let's say you don't fit in that cookie cutter box, right? So one of the most popular, especially for investors, again, we talked about this, is that as an investor, you want to lower your tax burden when you pay the IRS. So you're deducting as much as you can, especially if you got a good accountant. So Jason, and not just Jason, there's lenders out there that will actually do bank statement loans.
Yes.
Do you want to kind of explain what that means and how that works and what the benefits?
Bank statement loan, those are great. Bank statement loans, right? So you're self-employed. You have very low tax returns. You don't want to pay the IRS a whole bunch of money. However, your company is cash flowing, so we will request from you 12. I like to get 24 months bank statements. Okay, so we'll get 24 months bank statements from you, business bank statements. Now, certain lenders will only use 50% of the deposits. So what we're looking for is every month your deposits that are being put into the business, we then calculate that or divide it by 12 or 24, and we come up with a figure. Now, the thing is this: certain lenders will allow you to use 100% of those deposits. I have one here in Hollywood that we like to send a lot of deals to. The rate's a little bit higher because they know they fill a niche that's going to help out more borrowers. Then there's other lenders who will only let you use 50%. So that really hurts you sometimes. If you're depositing 10 grand a month and now we only can use 5 grand of it, that's not really helping us out too much. They might have a better rate, but in the end, you're still not going to get qualified. But the bank statement deals work just like that. We get your bank statements, whether they're business or personal, and we just kind of decipher which one we want to go with, or maybe sometimes we put a mixture of them together, because it's a very good picture to an underwriter and to a lender about what's going on. Like, can you afford this place? Sure. You got 24 months bank statements that says I made 300 grand, so that helps out. Now, the rate a little bit higher, not too bad though. I just quoted somebody like 4.3 on a bank statement deal. 10% down. I mean, quite frankly, that's pretty good. I mean, you're not going to get your 2.25 or something like that, but that's the trade-off. But the reality is it was a good rate, and they were happy with it, and they're kind of moving forward. So that's,
I mean, you quoted me something like that too. So just so you guys all know also is that, I got pre-approved with Jason. So, we always throw our cards out here also, but that's what I got quoted, 10% down.
Yeah.
And for me, I did the math, right? Versus, would I like to be under 2? I'd love to be under 2 or 2.25, whatever, that number is. But if you actually look at dollar amount, right? If you look at a $300,000 loan, it's not that much money versus how much I would have paid in taxes. I know how to negotiate, right? So I know I could get a better deal. I save the money as an agent. Mm-hmm. There's so many other factors that don't always look at the rate. Some of you old timers, that might be on this webinar. What was the rate 10 years ago or 15 years ago? Go ahead, put it in the chat. In the meantime, I do want to congratulate our winners for the Amazon gift card, Allison C. and Lillian J. So make sure you actually, text our office and we'll get it to Jason. And you guys are actually the winners of the $100 gift card. So they actually got, we actually have to pay them to listen. How about that?
I see Kenton saying 20%. I remember that, and it's funny. And this is like when we were talking before we got on the Zoom here, I had an investor, young fella, and he's like, well, if I can't get 3.5%, it's just not going to work for me. I looked at the cash flow and like he's cash flowing $600 a month on a duplex. We're putting down 25%, but if he doesn't get 3.5, he's going to walk. And that to me makes no sense. So the point here is if you're an investor and you're a legit investor, the rates are going to go up. There's no doubt about it. And are you going to get out of investing in properties because the rates are going up? No, you're still going to look for cash flow. You're still going to look for a good deal. 2%, 2.25%, 3%. That's like free money, you know. But the reality is, it's all about cash flow when it comes down to investors. And you know, when the rates go up, you still got to keep pumping that money in there to get those returns. So I think we're at the floor right now. Quite frankly, I think we're pretty low across the board. And as the year goes on, things will start to get a little better, and rates will start creeping up. But I think we'll still be okay.
Yeah. Yeah, I still laugh because I remember like some of the old timers that through our club. I feel like I'm becoming an old timer, but they were talking about 18, 19%. You know, when I first started doing mortgages back in 2000, it was like 9% was the refi,
Yeah.
you know, and prime and everyone. So, you know, some of you are newer people in real estate. You guys are kind of spoiled to even look at these numbers, you know, so that should not stop you from investing. You know, we talk about it, Ryan and I talk about it all the time. It's just another excuse to stop.
Yeah.
And the idea really is to use leverage, right? So
That's
I
it.
know I hear these people, right? Enough real estate investors that I just want to own this amount of doors and own it free and clear. Okay, I got you. That's peace of mind. I get it. But if you really want to leverage your business, the guys that I know that have 1,000 doors, hundreds of doors, they all have mortgages.
Yeah.
And they're leveraging and they're making sure, you know, the cash flow is there. And I think that's really important that, you know, when you're looking at deals, it might get you back in, right? Or if you have other partners, you got private money, get in the deal and then you could refinance them out and still cash flow. Otherwise, you know, how much or how long do you have to wait to save up $200,000 to pay cash?
I know.
Or 150? You know, most people you're working somewhere, it's hard, is what I would say. So I think that's always pretty important. Yeah. What about a little? I mean, because of time, a little bit also. What about some tips? Like, so I know one of the tips, you know, being self-employed that I know for a fact is I lease my cars and I have my business pay for it.
Correct.
And, you know, if you have your business pay for it for 12 months, correct me if it's still like that, but
It is.
basically it gets out of your debt ratio.
Right.
So
Omitting debt, that's one thing that we do look for when we start looking at credit reports, and especially with self-employed borrowers. All right, do you own this car? Comes up on your credit report, and we go to the taxes. The business pays for the car. Great, we can omit that $500 payment. Now you can go up and your purchasing power gets a little stronger. Even for individuals that are not self-employed, if you have a car note that you own, okay, and you're getting close to about 10 months on that note, we can omit that liability at 10 months. All right. So that's another way of saving a little bit of money and then adding more purchasing power. If you have a lease, you know, you're kind of stuck, you know, but those are some tips as far as omitting some debt. If there's a joint credit card account, husband and wife, let's say it's a joint account, husband's applying for the mortgage, we can then omit that liability from the husband's account because it's joint, and we'll say that, you know, the wife's responsible for payment on something like that. So those are some tips as far as qualifying. But one of the main tips is save your money. You know, as you can see with COVID, you have to have cash in this industry and in this business, and even in life. You know, save your money, make the investments that are appropriate. You know, Ryan and Anish are great at what they do. And let those guys really start to help you create that cash flow, because it's you never know what can happen. And last year, I think a lot of people had a rude awakening. If they're not sitting on some cash, they're in rough shape, you know. And fortunately for most of, you know, some of us, we were okay. But that's a good tip right there, right? Save your money. I tell my kids that all the time. They still
like,
come to me
thanks for showing up. Save your money. No, so
save your money and make sure you keep your credit looking sharp. Credit's super important nowadays. It's very, very credit sensitive right now. The stronger credit's always going to win. I got a police officer I've been trying to work with for 2 years, and he calls me every year and he's like, hey, what about now? And we look at his credit and it's just not there. And he's a cop and I want to help him out. He's a really good guy. But I think this time around he's listening, and he's going to get his credit cleaned up and stuff like that. But yeah, definitely manage your credit, make sure it's solid, save your money. And those are some of my tips. Those are kind of like tips everybody would give out, right, Anish?
Yeah, pretty much. I mean, but you know, those are some solid, you know, I mean, they're, you know, basic, but they're good ones.
Yeah.
You know, the other thing is, I guess we could also talk about, I know we didn't really talk much about this, but is like gifts, right? My rich uncle my rich uncle, no, I wish I had a rich uncle.
Yeah.
He wants to give me some money for a down payment. How does that work?
Oh, gifts. We love gifts, right? So with gifts, it works like this. If you have a rich uncle, family members, or anything like that, they can gift you 100% the down payment. Okay. So if you're a little short on cash, we can always use a gift from a family member. They would just write a gift letter stating they're going to give you X amount of dollars, what account it's coming from, and then just leave that gift money in that donor's account. All right. Don't have them transfer it to your account or anything like that. Leave it right where it's at until we get to a week prior to closing. And then we'll go ahead and instruct you to have the donor wire the money to the title company. It's a much smoother transaction that way instead of wiring it to you, because then we got to source the big funds, large deposits coming in and things like that. So gifts are always a winner when it comes to that. Even people with 401ks or annuities and things like that, where they can kind of tap into some additional cash that they need for down payment. Don't forget about those. We always have to remind people about that, because people are like, well, I don't have the cash, and all of a sudden they got 80 grand in a 401k and they don't realize they can get it. You can get it. You might need a little help getting it. I can help you put together whatever plan is needed for that, and get those funds out of there to free up to purchase your home. So definitely gifts are doable.
Yeah, and actually speaking about 401ks, next week or actually in 2 weeks, we'll have Carl Fisher from Camaplan. He'll
Okay.
talk about that. So sometimes there's penalties for certain things,
Yeah.
and sometimes there's no penalties. So you definitely want to know what can and cannot work for you. Again, it's about having a team. Really, it makes a big difference.
Yeah.
I don't know all these answers by any means, but I know Jason, so he makes my life easy.
Yeah.
Hey, what about this? What about that? And that's why I think it's really important to have solid people on your team. What about, I know we don't, and this drives me nuts too when I was doing mortgages. Hey, I'm in the middle of buying a house, but I want to buy a car and furniture at the same time. All those things.
That's
So
that's always a tough one. Don't make those big purchases while you're in the middle of a loan. If you got to do it, let me know. You know what I mean? Because what we do is at the end of a loan, we pull a credit refresh, we see if there's any new credit added, and sometimes there is, and then we have to identify it. That you open new credit, and it could blow up your deal. Maybe the debt ratio now is on the borderline at 55% for FHA, and now it's at 57. Now we have a dead deal. So definitely let me know. I did coach somebody up that's like, I got to get a car. I got to get a car. And so the payment was the same. No problem. It was a little added work for us. We had to get the agreement and stuff like that. We put it onto the credit report, but the payment was the same. But you don't want to add new credit, new furniture and things like that, racking up your credit cards. And if you lose your job during the process, let me know too. That helps, because we just had that happen to somebody. And he didn't really tell us he lost his job, but we found out when we verified employment. And all these lenders nowadays are going to call a day or two ahead of time, and they're going to make sure you're working. And if you're not working, guess what? Deal's dead, And so this poor guy, he was a refinance. He didn't think it was a good idea to tell us, and probably was trying to be slick. But we ended up finding out, and we had to cancel his deal. So, employment issues and stuff like that. Don't jump from job to job while you're getting a mortgage and make big ticket item purchases like a car or a boat. I did have one guy who bought a boat, and that was pretty funny because he ended up closing on the house, and he told me he never had a boat, but it was on his credit report. But we ended up getting that squared away. I went to his house to drop some gifts off, and I looked to the side of the house, and there's a boat. And I go, hey, his name was T. Hey, T, isn't that your boat? He's like, yeah, that's not my boat. He still said it wasn't his boat. That's my uncle's boat. So I said, okay, no problem. But he had a boat on his property. But it is what it is. So we have fun out there too with it, and we try to make it a little bit lighter than usual. But yeah, in all seriousness, don't make those kinds of purchases.
Yeah, and then the other one I always get that used to drive me nuts was, let's say I was a W-2 employee, right? I worked for ABC company.
Yeah.
And then I said, you know what? This pandemic happened. I want to start a business. I want to get it, so I'm going to quit. I'm going to quit my job, right? I saved money like you told me to, Jason, but I want to be a wholesaler, or I want to be an investor. So I just started my job, or not my company, I should say, not my job.
Yeah.
So what about some basic guidelines?
Yeah, that's kind of like a unique gift that, people that are experienced like myself, we like to tackle, and if you are not, you're 1099 and then you go to W-2, that's great. W-2 is always going to be top of the food chain when an underwriter is looking at qualifying income for you, right? If you go from W-2 to self-employed, guess what? We need a 2-year history. So you just shot yourself in the foot. Now we got to go with a 2-year history, and you're not going to get the conventional or FHA loan with the low rates. You can go ahead and get yourself a bank statement loan, but now it's a little different animal. When I take a look at certain deals, I just had a lady where she was getting paid 1099, and we had to prove a 2-year history. And so we advised her to get a Schedule C put together for the previous year, amend her tax returns, and she did it, and everything kind of worked out. But we always need a 2-year history. So if you're W-2 pay stub, 2-year history. Self-employed, 2-year history. Don't go from W-2 to self-employed and expect to get a house. It's just not going to work. You can go from self-employed to W-2. We're probably going to need a month's worth of pay stubs to make sure everything's kind of generating, but we can do that. And another thing too is if you graduated from school, from university, you got a nursing degree or something to that nature, we can use the time that you were in school as a 2-year history. Obviously, you only been working for 6 months, but you got a degree in finance or something like that, or a nursing degree. Obviously, we can use that. We just need to get your degree and put the timeline together, and we can use that as a 2-year history. But always remember, 2-year history is king, and we need that, whether you're self-employed or W-2 wage earner.
Yeah, and I think you kind of mentioned it earlier too. It's like, what happens, we'll do both scenarios, right? 2 years ago, I was making good money, and then COVID happened. They brought my hours down,
Yeah.
Or I was unemployed, and I was getting those checks, and then I'm working, but my hours are down. I know that's a lot more complicated. So how does it look at that?
Fannie Mae, conventional loans, Fannie Mae, Freddie Mac, they all put these COVID overlays in. They want to make sure that you're back to work, that you're kind of full throttle with making enough income. And there's always going to be a letter of explanation. Well, how come, you're doing well right now, but why is the year-to-date low? That's always something common an underwriter is going to say when I see the conditions. And we put a letter of explanation together. Hey, I was off for a month or 2 months. So we get a note from the employer stating that they had to shut down because of COVID, especially a lot of people in the restaurant industry. And you know what? It's common sense underwriting. You get some of those people that are a little bit hard-headed on the other side, but then you get common sense underwriters that look at it and say, all right, no problem. We could put this deal together, and we just patch it up with some letters of explanation and documentation from the employer. And as long as you can document it, we'll be okay. So it's not the end of the world if you didn't make as much money at the end of the year, but you're now, since September, you're on track and you're back to like 40 hours a week and stuff like that. So things are starting to get better in that regard.
Yeah. So again, and then the other end of it would be is like, what happens if, and I think you mentioned this earlier. So 2 years ago, I was making X amount of money.
Right.
But my business is thriving, right? And now, I made this amount of money. So let's say I made, I don't know, 50,000 2 years ago, but this year, you have an online business because it's a pandemic, you're blowing up, and now you made 100,000. Would they take the 100,000 as a qualification, or a 2-year average?
2-year average. And underwriters are always wanting to see going up, right? They don't want to see it going down. And so we don't want as a self-employed borrower, we want to make sure your income is steadily increasing. Okay. If there was a dip because of COVID, then obviously that would have to fall out of the 20% range. If it falls out of that 20-25% range, then you're probably not going to get a loan. Okay. If you're within that range from the previous year, then they might go ahead and accept it. But quite frankly, we just had a deal right now fall apart because the P&L came back and it was 25% lower than the previous year. And so obviously they got hit with COVID. They were in the flower business and it kind of hurt them a little bit. But the reality is, you want to have a steady income as a self-employed borrower going up. And we always look at a 2-year average. But like you said, we can't just take your greatest month or greatest year that you had for 500K and then all of a sudden ignore the other 3 years where you made nothing. It's just the inconsistency of a self-employed borrower, and they don't necessarily like that.
Yeah, makes sense. I mean, if I was lending my money, basically, remember, they want to see consistency.
Right.
It's your ability to repay, right?
Right.
And part of that is your credit too. I've seen people back in my days, you've probably seen it too, that made a ton of money, doctors, made 7 figures, but their score was low, like under 620, right? So just because you make money, right, doesn't mean your ability to repay. And that's what, lenders are worried about, right? Wouldn't you be worried about the same way? Hey, if I lent Jason $100, is he going to pay me back?
Right.
And these are the factors. So that's something to catch, think of it that way. would you feel more, and the more you know about a person, the more likely you are to lend to them, right? So if you're
Absolutely.
doing, limited income or no income, I think we're kind of talking about there might be a few local lenders.
Yeah.
Are they doing no income? If they're just
Yeah,
credit based?
there is a couple of local lenders that are doing no income for some primary purchases, which I kind of find it kind of unique, and I don't know how they're really putting those together, but they're starting to come out because the money's cheap right now, and if they can make a 7 or 8% gain on it, that's pretty good for them. But there is some lenders out there that are doing, but you got to put some money down, 40% or so, especially for a primary. Um, because primaries are a little scary nowadays, But investments, you're probably looking at the same, 25 to 30% down on the no income docs.
That's not bad. Man, I thought those days would never come back. It's funny to see some of these things coming back that I'm like, wow, bank
Yeah,
statement loans and
yeah.
yeah,
Well, we
but
do
I mean
have
that's
another
yeah,
loan. It's a debt service ratio loan, and that's specific for investors where basically it's 20% down. You don't put any income or any assets on the application. And it's basically based off your credit score and how the property is cash flowing. All right. And they're pretty good rates for those, they're not bad at all, especially for if you want to avoid hard money rates, they're probably in the, mid to mid sixes or something like that. So
yeah,
that's not
that's
bad.
not bad.
Yeah.
And that's the thing is like once you get in, you're in it. Hopefully your equity is growing, and down the road, if you want to take out some of that equity and refi, again, I don't have the crystal ball about rates. I think they're going to be pretty low this year. Also,
Yeah.
I don't see some massive jump to and usually historically, it'll take some years to get back.
Yeah.
I think, but again, I'm not running the Fed, so I couldn't tell you, but I got a good feeling that they're going to keep it a little bit low, so it is a good time.
Yeah.
Roy's asking the difference for your debt to income ratio, conventional versus FHA. So on the back end, right,
Right.
are the FHA limits a little bit higher?
Yeah, that's why you're able to purchase a little more home going FHA versus conventional. You can go up to 55% on your back end ratio. With conventional, you're capped at 50. And lately, the way the system is running, what I mean system is that when I plug in my system and I ask for a DU approval, it's not liking the 49.9% back end ratio for conventional loans. For FHA, they're a little more liberal in that way. But for conventional loans, they like it to be closer to 47 lately, and even 45, so I would look at it like that: 55 for FHA, 50% for conventional if you got really good credit and some decent assets to use as compensating factors.
Yeah, and just so you guys know, like debt to income, if you made $10,000 a month, he's talking about FHA would go up to 5,500, and that's all your payments, your minimum payments.
Right.
The other, and the one that kills me also is what happens. I make really good money, right? But I charge a lot of things for my business or even on my personal to get those points, but I paid in full,
Okay.
right? So how does that work? Because the bank usually looks at when they pull your credit, they're getting a snapshot of where you are,
Mhm.
right?
Right.
For that day, I guess is probably the easiest way. And let's say I charged, I don't know, $10,000 of materials because I'm rehabbing
Right.
my personal credit card, and my minimum payment is, I don't know, $100 or 150. But you could see, does the bank look into account that I pay my credit cards in full, or will they use that same deposit or for like debt to income?
Well, I mean, if you have the 30-day account, like an Amex, like a lot of people have Amex cards, and there might be carrying a balance of $5,000 when I pull their credit, and the payoff is $5,000. We just got to make sure that, first of all, I omit that. I don't run that in there, okay, because of the 30-day account. And then we just have to make sure they have enough money in their bank to actually pay for that, along with closing costs and down payment and so forth. Now, if for that brief moment when we pull credit and you're all maxed out on your credit cards, but you got the money to pay it down, we can do a rapid rescore. All right, get me the new statements. You can say, hey, Jay, listen, I just paid all that stuff off last week. I don't know why it's reflecting this way. Get me the new statements. I'll put them into our credit team, and our credit team will do a supplement, right? And we'll do a rapid rescore and get your credit score where it needs to be in order to qualify. So I mean, it's the bank does look at it, yeah, but it's really me looking at it, making sure I can get you the rate that I promised you, and that it makes sense, you know. So we can definitely do a rapid rescore and kind of take care of that with the same credit report.
Yeah, makes sense. I mean, and if I was going under contract, are you closing in 30 days? I know it's like a wild west, or if I was,
Yeah.
if I found a property, should I put a contract for 45 days for closing, or are you
That's
getting
a
it
good
done in
question.
30?
I think every circumstance is different. Like I wouldn't tell somebody, hey, yeah, we're going to close you out in 30 days on a bank statement deal. No, I wouldn't do that. I don't trust the banks to move that quickly because these banks don't operate like that. You know, if you are kind of a cookie cutter system, a borrower where it's pay stub W-2s and there's not too many moving pieces, sure, no problem. I have no problem calling a 30-day close on that because I already got you pre-approved. I know when I get you in there, it's
Right.
going to move kind of quick. And I have no issues with that. But everyone's a little different. You know, if you're the self-employed borrower and you own multiple homes and you're not getting back to me the way I want you to get back to me, and we're kind of dragging your feet a little bit and get me some documents, I'm not going to put you or anyone in my staff on a 30-day close because that's just a recipe for disaster. Sometimes, you just gotta, tell people the truth and say, hey, look, the reality is like, I can get this deal done in 35 days. All right. Maybe not 30, but 35, 40 days. But, 30 days is not going to happen, especially in this environment. But yeah, for the most part, we're pretty quick. We're pretty efficient as far as getting those easier deals done quickly. And honestly, some of these refinances we're getting these, what's pretty cool is these PIWs, property inspection waivers, where they're not even going out there and appraising the property. And we're getting a lot of those on the refinances because of the low LTVs, the good credit scores, and there's comps out there now. So that expedites our closings very quickly. But on purchases, most people want to know their appraised value. So even if I do get a PIW on the property,
Yeah.
people want an appraisal anyways. And I had somebody do just that. Like, I want appraisal, I don't care. All right, no problem. We'll get you one. He had the money, he could pay for it, so he was okay with it. But yeah, we can definitely turn them around pretty quickly.
Absolutely. So I know that there's been a lot of questions in the chat. Due to time, we won't be able to get through all those questions. We did put, Jason's information in the chat. Jason, you want to put your info in the chat, maybe,
Yeah, sure.
in case they want to contact you? Because I see a lot of specific cases, and what you could do is, run the scenario by Jason is what I would say. He's licensed in Florida only, though. That's the other thing I do want to let anyone know. Because I do have people that are looking to buy in other states. So
Right.
he's a licensed mortgage guy in Florida only. So I think that's always important. Again, if you're looking to buy properties, he could, again, get you pre-approved. To get a solid pre-approval, fill out the application, fill it out correctly, right? He's
Yeah.
going to find out. So don't put the numbers that you want him to hear. Put the real numbers, right? I really make this amount of money. Couple basics, tips that I'll add. Have your 2 years tax returns, all pages,
Yeah.
right? If you're self-employed, have all your tax returns for each company. So you have 2 or 3 companies, have them ready.
Mm-hmm.
If you're a W-2 employee, have your W-2s, your 2-year tax returns, and a couple pay stubs, 2 months bank statements, all pages, right? If you have retirement, the more stuff you have with them, it's going to be easier, and that approval will be, I don't want to say solid, but it'll be a stronger approval. Because if you only give him, the application stuff and he doesn't verify your tax returns, right? And that always happens, especially with self-employed. Hey, I made $100,000 last year. Well, yes and no. I know you did, but after your deductions, you only made 30.
Yeah.
Right. So
Yeah,
it's going to help solve those things quick. And you might move into, a bank statement loan or an alternative or a no doc or whatever it is. It's going to save you a lot of headache up front. The condos, I know we kind of just touched, we could probably do a 3-hour webinar here. But the condos, because of the associations, you're going to want to make sure they do condo questionnaires.
Oh, yeah.
So if you don't want to touch a condo questionnaire, was it 20% down or 25%?
We have a guy like that right now where we were flying through it. Everything was looking great. And it was 3% down. We get the condo questionnaire back. and they're not collecting reserves for 2021. It was an amendment that they put in there just recently, because in October they were fine, but now they're not collecting reserves. So that basically blows up this guy's deal. Fortunately, he's buying it from his brother. So what we did is we restructured the loan where there's a gift of equity coming in for 10% down. However, the borrower had to get one loan at 75% and a second mortgage at 15%, not rate, but a 15% down payment to make it 90%. So he has 90% financing, 10% down from the gift of equity from his brother, and everybody's kind of happy about it. All right. The only one that really isn't happy is the brother, because he's not getting as much money back as he thought he was going to get back on the net. Right. But the reality is, I don't understand why the condo association approved that. They're not collecting reserves for 2021, which made no sense to me at all. But that's just kind of how it goes sometimes.
And to add that, so like, remember, the borrower is approved. You could be approved, the property might not be approved.
True. Yes.
Right? Whether it's a high rise condo, you might be approved for FHA at 3.5%. That high rise condo will not be, most likely.
Yeah, that's another hurdle to get over.
It's a whole different world. So that's why you want to really have a good relationship with your mortgage person. And sometimes some of the cookie cutter companies online, they're not going to have that. And they're not going to know our area, and they're not going to, so it might be a no with that, and
the realtors might not even know neither. I see a lot of realtors, they list properties, conventional FHA financing on a condo. And I'm like, wait a second, I'll jump into MLS and I'll look at the closed sales and I'll take a look, and look, there's 14 cash deals. There's not even one finance deal in the last 2 years. I know there's probably a good likelihood it's not going to get financing for conventional financing. So then I'll reach out to that realtor and explain to them what's going on. And more than 9 times out of 10, yeah, they're right. I'm right, where it's like, okay, well, we got to put down 25% and this is how we got to work it. So as far as helping realtors advertise correctly, we also do that too, to help out our partners. But having a local guy is important.
Yeah, absolutely. So I want to thank you, Jason.
Thank you.
Those 90 minutes went pretty fast. And, I apologize for all the questions we couldn't get to. We put Jason's information. I did see a lot of questions specifically for their own situation.
Okay.
It's too hard to hit on those broad strokes, to go through that, and if you're looking to buy properties, get pre-approved, right? Leverage it, do what you can, and it'll make it easier for you too. So again, we want to thank everybody for joining us. Jason again,
and Alexa.
We had a good time. We'll probably have Jason come back. Hopefully, you guys will give us a 5-star Google review when I send one out for Jason. Let us know if there's anything else or any other topics that you guys are interested. We'll try to get other corporates. We'll probably have Jason come back in a couple of months too, as lender guidelines change. We could always do that. And again, we want to be out there investing. The key is to learn today. Hopefully today opened your eyes. All our replays will be on our YouTube channel in the next 48 hours. So again, Jason, good to see you virtually.
Thank you, Thank you very much.
Appreciate it, man. Take care.
Bye, Alexa. Take care, guys. Thank you, everyone. Bye.